For the last few years, the investment story has sounded almost hypnotic. AI is everything. It's the future of work, the engine of creativity, the only path to exponential growth. Trillions have been poured into anything with a chip, a model, or .ai on the end, chasing this idea of infinite scalability and limitless upside. But in 2026, a quieter truth is starting to show through the noise. We are rapidly running into a physical wall. The digital world feels weightless. It lives in the cloud, it streams to your phone, it's sold as software with zero marginal cost. But underneath that illusion is a brutally physical reality. Data centers don't live in the cloud, they live in industrial parks. Models don't run on ideas, they run on chips wired with copper. Infinite compute runs on very finite grids and fuel. The digital world is saturating. And the tangible world, the world of energy, raw materials, hardware, and physical security, isn't just also important. It is becoming the ultimate bottleneck. And that's where the ultimate asymmetric opportunity lives. Welcome back to The Rational Risk. We're not here to dunk on AI or pretend it's a fad. AI is real, it's powerful, it is going to reshape a lot of things. What we are doing today is stepping back from the hype and asking a different question. If AI really does eat the world, who gets paid just for selling the electricity, the metal, and the machines it needs to stay alive? I call this the anti-AI trade, not anti in the sense of shorting AI. Anti in the sense of owning the real-world bedrock that AI absolutely cannot exist without. In this video, we'll look at 3 sectors that sit underneath the AI story. Number 1, copper, the connective tissue of the digital age. Number 2, nuclear and baseload power, the energy backbone. And number 3, physical security and manual automation, the arms and legs of the system. This is really a story about asymmetric scarcity. Digital services can be copied at almost zero cost. You can ship the same piece of code to 1 user or 1 billion users. But the physical resources that power, cool, connect, and protect that code are finite, slow to scale, and getting tighter. If you can spot those bottlenecks early, you end up with a very particular risk-reward shape. Downside capped, because these are essential, tangible assets with intrinsic value. Upside open-ended, as the digital world competes harder and harder for a limited, inelastic supply. That's the edge a rational risk investor is looking for. Quick disclaimer before we dive in. This is not financial advice. I'm not your advisor, I don't know your situation, and I'm not telling you what to click on in your broker app. I'm showing you a way to think about risk that's grounded in physics and supply, not just narratives. Let's start with the metal that quietly runs through everything. Copper. Copper is one of those words your brain wants to skip. It sounds like plumbing. It's not glamorous. Nobody's flexing their copper position on social media. But if you quietly trace the wiring behind almost every big theme of this decade, you keep running into the same orange metal. Every hyperscale data center, the literal brain of AI, is stuffed with kilometers of copper wiring. Every electric vehicle carries tens of kilos of copper in its motors, inverters, and wiring looms. Every solar farm, every wind farm, every grid upgrade depends on it for efficient energy transfer. And all of that is happening at once. In 2026, we're not just dealing with a bad quarter or a temporary tight market. We are staring at a structural deficit. The mining industry simply cannot bring new copper supply online fast enough to match the exponential pull from AI infrastructure, electrification, decarbonization, and good old-fashioned urbanization and industrial growth. This isn't just another commodity cycle. In a very real sense, copper is becoming the new digital oil. So why is copper such an asymmetric bet? From a risk perspective, it has a shape I like. On the downside, copper is a fundamental industrial metal. It's baked into modern civilization. There is no cheap, large-scale substitute that matches its electrical and thermal properties. Even if AI hype cools down or EV adoption slows, or we underestimate how long this cycle takes, we're still going to wire new homes, expand grids, and maintain factories. Demand can wobble. It doesn't vanish. On the upside, the constraint is real and slow. New copper mines typically take 10 to 15 years from discovery to meaningful production. Existing mines are getting deeper, more complex, and more expensive. Local communities and regulators are not exactly queuing up to approve new open pits, so you have an industry that cannot respond quickly, being hit from all sides by electrification and AI. That's asymmetric scarcity in one chart. The floor under demand is solid because copper is fundamental. The ceiling on price is hard to see because supply can't grow quickly, even if we want it to. That doesn't mean copper goes up in a straight line. Commodities never do. They overshoot in both directions. But if you zoom out, the mismatch between physical reality and digital ambition is obvious. So how do people try to express this theme without turning into full-time geologists? Broadly, there are three buckets. First, Tier 1 copper miners. These are large, low-cost producers with long mine lives and decent balance sheets. They're the boring names that survive full cycles. They're not sexy, but they're still standing when prices drop. Second, producers with expansion or restart projects. These are companies that can expand existing operations, restart high-quality assets, or push brownfield projects forward faster than somebody can build a brand new mine from scratch. This is where you sometimes find more leverage and more risk. And third, recycling and scrap players. Businesses that mine copper from the urban layer, old cars, cables, appliances, electronics. As primary ore gets tougher and more expensive, these guys go from sideshow to main act. You can also go further out on the risk curve with junior explorers, small companies with promising deposits, but a lot of execution risk. That's where the leverage can be wild in both directions. The point here isn't to recommend specific tickers. The point is to shift the question. Instead of asking which AI software stock will win the hype war, you start asking who's quietly selling the metal that all of them are bidding for, whether they like it or not. With copper in place, let's move one level up the stack to the thing that actually makes all this silicon do anything: electricity. If copper is the connective tissue of the AI era, electricity is the bloodstream. There's a detail that often gets buried in AI marketing. Running large models is brutally energy hungry. A single big data center can draw as much power as a small city. Now multiply that by bigger, more complex models, denser racks packed with specialized chips, and 24/7 inference workloads for millions of users. At the same time, our grids are already juggling EV charging, electrified heating and industry, and the politics of decarbonization. We end up with what I think of as the AI power paradox. The companies selling you a story about frictionless digital intelligence are quietly in a very old-fashioned business. They have to secure huge, predictable blocks of megawatts. So what kind of power do we actually need to keep this going? It has to be reliable, not just when the sun shines or the wind blows. It has to be low carbon, at least in countries that care about climate targets. It has to be dense enough to sit reasonably close to where data centers are being built. You absolutely need solar, wind, and batteries in that mix. They're critical. But when you want round-the-clock, high-density, low-carbon baseload, the conversation keeps drifting back to one uncomfortable word: nuclear. That's why you're seeing more attention on things like small modular reactors, SMRs, factory-built, standardized reactor units designed to be cheaper, safer, and faster to deploy. Advanced nuclear concepts with alternative coolants, fuel cycles, and safety features aimed at solving some of the pain points of legacy reactors. And long-dated power purchase agreements, where tech giants lock in nuclear-sourced power for decades to keep their AI infrastructure running. From a rational risk perspective, this is classic asymmetry. On the downside, societies still need reliable baseload power, even if AI under-delivers. Hospitals, trains, factories, and cities all depend on electricity, whether the next model release is a hit or not. Governments under pressure to decarbonize are slowly realizing there aren't many tools that can deliver big chunks of low-carbon power at scale. That creates a demand floor that has nothing to do with hype cycles. On the upside, if AI demand really explodes and grids start to creak, projects that can deliver firm, low-carbon power move from interesting to system-critical very fast. Capital, policy, and long-term contracts tend to follow that urgency. You don't have to believe every nuclear press release. You just have to accept a simple constraint. If we want more and more AI, cheap and clean, something in this space has to work. Again, not recommendations, just the usual hunting grounds. You've got SMR and advanced reactor developers, companies actually pushing designs through regulators, signing partnerships, and working with utilities, not just making slides. You've got uranium miners and fuel cycle businesses, the people who find, extract, and process the fuel that keeps reactors online. When nuclear cycles turn, these names can move violently. And you've got utilities with credible nuclear plans, especially those with existing nuclear fleets, or clear, funded plans to expand or restart nuclear capacity. None of this is simple. Nuclear comes with political risk, regulatory risk, long lead times, and a real history that people remember. But if you step back from the noise, the AI era is quietly forcing a nuclear reality check. You can't have infinite intelligence on top of a grid that's held together with vibes. Let's move to the third leg of the anti-AI trade, the place where AI finally grows arms and legs. AI is extremely good at sitting in a text box. It can summarize reports, write code, generate art, and argue confidently with strangers online. But on its own, it can't pick up a box, patrol a fence, or fix a leaking pipe. To interact with the real world, AI needs hardware. Legs, wheels, arms, sensors, drones, cameras, gates, conveyor belts, all the unglamorous gear that lives in warehouses, factories, ports, and out at the edge of the grid. Right now, some of the highest value uses of AI have nothing to do with chatbots. They're systems that watch physical spaces and spot problems before humans do, that automate repetitive, heavy, or awkward tasks, and that knit cameras, sensors, and software into real-time nervous systems for physical sites. Behind that is a simple, uncomfortable macro trend. In a lot of developed countries, there's a persistent labor shortage, especially for exactly this kind of work. Night shifts, remote locations, physically demanding roles. At the same time, the value of the assets we're trying to protect, data centers, substations, logistics hubs, keeps going up. So again, the asymmetry shows up. On the downside, companies will always need to secure physical assets. They will always need people or machines to move boxes, inspect equipment, and handle essential manual tasks. That demand is stubborn. It doesn't disappear because a new model launches. On the upside, as AI vision and planning get better and as hardware gets cheaper, more and more of the existing physical world becomes automatable. Every camera becomes a potential smart sensor. Every warehouse becomes a candidate for dense robotics. Every high-value site becomes a candidate for layered, AI-integrated security. This is where the anti-AI label is slightly tongue-in-cheek. You're not betting against AI. You're betting on all of the heavy, messy, physical stuff AI has to move and protect to be useful. Again, three rough buckets investors tend to look at. Industrial and logistics automation, companies that build the robots, conveyor systems, and control software that run warehouses and factories. Their value isn't just in the robot, it's in the whole system that lets fewer humans do more work, more safely. Physical security platforms, firms that integrate cameras, sensors, access control, and analytics into a single smart security layer, not just dumb CCTV and locks. And robotics platforms, from warehouse bots and last-mile delivery units to inspection robots and security drones. Anyone building reliable bodies that an AI brain can inhabit. You can go further out on the curve with humanoid robotics too. That space is still early and very speculative, but the payoff, if a few players get it right, could be extremely asymmetric. Again, this is not about guessing which logo wins. It's about owning the arms and legs of the AI revolution. If you strip away the buzzwords, the story of AI in 2026 is simple. We've built a huge, hungry digital brain on top of a planet with hard limits. That brain needs metal to connect it, it needs power to run it, and it needs hardware to do anything useful outside a screen. That's the heart of the anti-AI trade. You don't have to win the lottery by guessing which AI software stock outperforms all the others. You can step underneath the hype and ask, which metals become bottlenecks as this scales? Which power sources become non-negotiable as grids tighten? Which physical systems become the default way we secure and automate the real world? Copper, nuclear and baseload power, physical security and manual automation. Each of these has its own risks, politics and time horizons. None of them are simple. None of them are as fun to talk about at parties as the latest model drop. But when the music slows down, it's usually the people who own the infrastructure, the wiring, the power plants, the robots, who are still sitting in their chairs. So where does that leave you as an investor? Not with a punch list of tickers to copy, it leaves you with a different lens. When you see the next AI headline, ask yourself, what does this really need in the real world to exist? Who supplies that metal, that power, that hardware? And is the world about to discover that supply is a lot tighter than the pitch deck suggests? If you found this useful, consider subscribing to The Rational Risk. This channel is about mapping asymmetric risk in a world that's changing faster than most portfolios. In the next episode, we'll go one level deeper into the real-world side of this story and look at how ownership itself is changing, how the world's most valuable physical assets are getting sliced into digital pieces, and what tokenization of everything actually means beyond the buzzword. Until then, think rationally, respect the constraints, and own at least a small piece of the real world.